Welcome back to Mind Over Markets, the channel where we master the psychology behind trading success. In today's episode, we're diving into a silent account killer that most beginners don't even realize is hurting them. How overconfidence destroys beginners. Overconfidence doesn't show up as fear. It doesn't feel dangerous. In fact, it feels powerful. It feels like certainty, like skill, like momentum. But beneath that feeling often lies impulsive risk, broken discipline, and avoidable losses. In this episode, we're breaking this down into 5 powerful parts. First, we'll uncover the dangerous illusion of early success and why winning too soon can be risky. Second, we'll talk about position, sizing, and how ego becomes expensive when confidence outpaces skill. Third, we'll explore how overconfidence leads traders to ignore their plan and chase the market. Fourth, we'll examine how ego blocks growth and shuts down learning. And finally, in part 5, we'll discuss humility, the true antidote to trading, destruction, and what separates survivors from those who quit. Each part connects to the next, building a complete picture of how this hidden psychological trap works, and more importantly, how to avoid it. So stay with me until the end, because understanding this could be the difference between short-term excitement and long-term survival in the markets. Let's get into it. Overconfidence often begins with a win. A beginner enters the market cautiously. They study charts carefully. They hesitate before clicking the buy or sell button. Every decision feels heavy, almost intimidating. Their first trade is small. Their heart beats faster than usual. They are aware of the risk. They respect it. Then something happens. The market moves in their favor. The trade closes in profit. Relief floods in. A second trade follows. Another win. Maybe even a third. The account balance rises. The numbers look better than expected. Confidence begins to replace fear. And slowly, quietly, something shifts. The trader begins to believe they understand more than they actually do. Early success in trading is one of the most dangerous experiences for a beginner. It creates the illusion of skill before true competence has been developed. A few positive outcomes feel like confirmation of talent. The trader starts to think, maybe I'm naturally good at this. Maybe I see something others don't. But what they fail to realize is that markets can reward randomness in the short term. A rising market can make almost anyone look smart. During strong trends, even poorly timed entries can drift into profit. When conditions are favorable, mistakes are hidden. Risk appears smaller than it truly is because the environment is forgiving. Instead of attributing those early wins to favorable market conditions, timing, or simple probability, the beginner attributes them to personal ability. This is where overconfidence is born, not from deep knowledge, not from mastery, but from a misunderstanding of what actually caused the success. The danger is subtle. Nothing dramatic changes overnight. There is no loud announcement. Instead, discipline begins to loosen in small ways. The trader stops reviewing trades with the same intensity. Journaling becomes inconsistent. Risk calculations become less precise. After all, if the strategy is working, why question it? Winning feels like validation, and validation feeds ego. Overconfidence whispers dangerous thoughts. I don't need to follow the plan exactly this time. I can increase my position size. I've earned it. I can predict this next move. I don't need a stop loss here. I'll just add a little more to this position. Each thought seems small and harmless, but together, they mark a psychological turning point. What started as caution turns into assumption. What started as discipline turns into impulse. The market has not changed. The trader has. This is the critical mistake. The beginner believes their growth in confidence reflects growth in skill, but confidence can grow much faster than competence. In fact, the less someone truly understands, the easier it is to overestimate their ability. They have not yet experienced enough losing streaks, unexpected volatility, or sudden reversals to appreciate the depth of uncertainty in the markets. The market punishes ego faster than ignorance. An ignorant trader may act cautiously because they know they don't know much. An overconfident trader acts boldly because they believe they do. And boldness without a foundation is dangerous. Beginners rarely blow accounts because they lack intelligence. Many are smart, capable, and motivated. They blow accounts because they overestimate their understanding. They mistake a small sample size for proof. 3 or 4 wins feel like a pattern. A good week feels like a system. A lucky month feels like mastery. But markets operate on probabilities, not certainties. Any strategy, no matter how strong, will experience losses. Any edge reveals itself only over a large number of trades. When a trader increases risk prematurely, before their edge has been tested across different conditions, they expose themselves to volatility they are not psychologically prepared to handle. The illusion of early success is powerful. It convinces beginners that risk is smaller than it truly is. It creates the belief that drawdowns will be shallow, that losses will be rare, that control is stronger than it really is. It blinds them to the reality that markets are dynamic, unpredictable, and influenced by countless variables beyond any one person's analysis. Overconfidence also distorts decision-making. The trader begins to seek trades not because they meet criteria, but because they feel certain. They enter earlier, they exit later, they hold losers longer, convinced the market will eventually validate their view. They double down to prove they are right. And eventually, the market shifts. The easy wins disappear. Volatility increases. Trends reverse. Suddenly, the same approach that produced smooth gains now produces sharp losses. But by this point, position sizes are larger. Risk exposure is higher. The emotional attachment to being right is stronger. The fall is faster than the rise. Overconfidence does not arrive loudly. It grows quietly inside small victories. It hides behind success. It disguises itself as growth. And because it feels good, it is rarely questioned. The most dangerous phase for a beginner is not the losing streak at the beginning. It is the winning streak at the start, because that is when the seeds are planted. If unchecked, overconfidence sets the stage for destruction, not because the trader lacked potential, but because they mistook early luck for a lasting skill. The clearest sign that overconfidence has taken control is position sizing. You can hear it in the language a trader begins to use. The careful calculations start to fade. The fixed percentage risk per trade slowly increases. The protective boundaries that once felt essential begin to feel restrictive. A beginner who was once cautious starts trading larger. At first, it feels reasonable, logical, even. If I was right with 1 lot, imagine what I'll make with 5. The math looks attractive. The potential profit multiplies. The account balance seems ready for acceleration. But this is where ego quietly turns into financial risk. Overconfidence pushes traders to increase exposure before increasing skill. They raise their risk per trade without strengthening their strategy. They expand size without expanding consistency. They assume that because they've won recently, they've earned the right to press harder. What they fail to see is that markets do not reward confidence. They reward discipline. When position size increases prematurely, volatility feels different. A small pullback that once looked harmless now causes emotional tension. A routine loss now feels heavy. The same normal market fluctuations become psychologically amplified because more money is attached to every tick. Overconfident traders stop respecting drawdowns. They underestimate how quickly a series of losses can compound. They assume the next trade will recover the previous one. They begin to view risk as temporary rather than structural, and the market responds. 1 loss at a larger position size can wipe out weeks of careful gains. 2 losses can shake confidence entirely. 3 losses, taken without proper risk control, can devastate an account. The irony is painful. The trader who once protected every dollar now exposes large portions of capital in a single idea. The shift is not technical, it is psychological. Overconfidence makes beginners believe that losses are unlikely. But losses are not rare events in trading. They are guaranteed events. No strategy wins every time. Even the most refined systems experience losing streaks. Probability does not care about recent success. It does not adjust because a trader feels in sync with the market. When risk increases faster than discipline, disaster follows. Larger position sizes demand stronger emotional control. They require deeper statistical confidence in a strategy. They require proven consistency across changing market conditions. Without those foundations, increasing size is not confidence. It is gambling disguised as ambition. What overconfident traders fail to understand is that professionals think differently. Professional traders focus on capital preservation first. Growth is secondary. They measure success not by how much they can make in a week, but by how long they can survive in the game. They assume they can be wrong. They plan for it. Every trade begins with the question, what happens if this fails? They expect losses. They size positions so that a single trade cannot damage them significantly. They respect volatility because they understand it cannot be controlled. Beginners, when overconfident, assume they will be right. That assumption is costly. Instead of asking, how much can I lose? They ask, how much can I make? Instead of calculating worst-case scenarios, they visualize best-case outcomes. The focus shifts from protection to expansion. Risk management starts to feel boring during winning streaks. It feels like a limitation. It feels unnecessary. Why risk only 1% when you could risk 5%? Why grow slowly when you could grow quickly? But risk management exists specifically for the moments when the market turns. And it always turns. Markets cycle through trends and consolidations, high volatility and low volatility, clarity and confusion. A strategy that thrives in one environment may struggle in another. When conditions change, larger position sizes magnify the impact of being wrong. Overconfidence convinces beginners that they are in control of the market, but in reality, they are only in control of their behavior. They cannot control price. They cannot control sudden news. They cannot control liquidity shifts or unexpected reversals. The only true control they have is over position size, risk limits, and execution discipline. The moment behavior becomes reckless, the account becomes vulnerable. It does not collapse because the trader lacked intelligence. It collapses because exposure outpaced preparation, because size increased faster than skill, because ego overruled caution. Position sizing is not just a technical decision, it is a psychological mirror. It reflects how a trader truly sees themselves. Careful sizing reflects humility. Aggressive, unjustified sizing reflects overconfidence. And in trading, humility protects capital. Overconfidence risks it. Another way overconfidence destroys beginners is by disconnecting them from their trading plan. In the beginning, the plan meant everything. They had rules, clear entries based on specific conditions, defined stop losses placed with intention, structured take profits aligned with risk-to-reward ratios. Every trade had logic behind it. Every action had a reason. The plan created boundaries, and those boundaries created safety. It wasn't perfect, but it provided structure in an environment that is naturally uncertain. Then the wins start stacking up. After a series of successful trades, the rules begin to feel less essential. The trader starts thinking, I understand the market now. What once felt like necessary discipline now feels like restriction. Overconfidence whispers subtle suggestions. I don't need confirmation this time. It's obvious where price is going. I'll just move my stop slightly. It's too tight. I'll let this one run longer. I have a good feeling. At first, the deviations are small. A slightly earlier entry. A stop loss moved a few points further. A take profit adjusted on the fly. Each decision seems harmless. Each adjustment feels justified in the moment. Small rule breaks become bigger ones. The trader doesn't wake up one day and abandon the system completely. Instead, they slowly chip away at it. They override signals. They ignore filters. They convince themselves that experience now replaces structure. Soon, the trader is no longer following a system. They are following emotion, disguised as intuition. That distinction is critical. True intuition in trading is built over years of screen time, data, and repeated exposure to patterns across different market cycles. It is grounded in experience and reinforced by evidence. What beginners often call intuition is simply confidence fueled by recent success. And the dangerous part, it often works, temporarily. A few impulsive trades succeed. An early entry catches a strong move. A widened stop survives a pullback and price eventually hits target. These outcomes reinforce the belief that strict rules are optional, that discipline is flexible, that the trader has evolved beyond the need for rigid structure. Success without discipline is intoxicating. It creates the illusion that freedom produces better results than consistency. The trader begins to feel clever, adaptive, superior to their old, overly cautious self. But markets punish inconsistency. What works once may fail the next time. The impulsive entry that previously caught a breakout now gets trapped in a false move. The widened stop that once saved a trade now magnifies a loss. The extended take profit that worked last week now turns a winner into a break-even trade. Without rules, there is no baseline. Without a baseline, there is no way to measure performance objectively. The trader begins chasing moves they missed. They see price running without them and jump in late. They exit early out of fear when trades hesitate. They hold losers to long because it will come back. They add to positions to defend their original idea. Each decision is reactive rather than planned. Overconfidence transforms calculated decisions into emotional reactions. The trading plan was designed during calm moments. It was created with logic, backtesting, reflection, and deliberate thought. It accounted for risk. It respected uncertainty. It assumed imperfection. But overconfidence destroys it during emotional moments. When adrenaline is high and money is on the line, ego becomes louder than logic. The trader begins trading based on how they feel rather than what their system dictates. The market becomes a stage for proving themselves right rather than executing a tested edge. And here lies the deeper problem. Once the plan is compromised, accountability disappears. If a trade loses, was it the strategy or the deviation? If a week ends negative, was it market conditions or inconsistent execution? The trader can no longer tell. Performance becomes confusing. Results feel random. Confidence starts swinging between extreme highs and crushing lows. Without a plan, trading becomes gambling. Not because analysis disappears entirely, but because structure does. Decisions are no longer anchored to predefined criteria. They are influenced by recent wins, recent losses, fear of missing out, and the desire to recover quickly. And gambling with an inflated ego accelerates losses. Overconfidence convinces beginners that flexibility equals skill, but in reality, discipline is what creates long-term freedom. Structure is what protects capital. Rules are what allow a trader to survive inevitable downturns. A trading plan is not a cage. It is a shield. The moment a trader believes they have outgrown their own rules is often the moment they become most vulnerable, because the market does not reward confidence. It rewards consistency, and consistency only exists when the plan remains intact, especially when emotions are loudest. Overconfidence closes the mind. In the early stages of trading, curiosity is strong. A beginner studies charts late into the night. They replay sessions. They consume books, videos, and insights from experienced traders. Every loss is examined carefully. Every mistake becomes a lesson. There is humility in the beginning. But when success comes too easily, something shifts. A beginner who starts to feel invincible gradually reduces their effort to improve. They stop studying with the same intensity. They stop reviewing losing trades properly. Instead of asking, "What did I miss?" they begin asking, "Why did the market do this to me?" That subtle change in question reveals a deeper change in mindset. Blame replaces responsibility. Instead of analyzing execution, they criticize volatility. Instead of examining their entries, they complain about manipulation. Instead of refining their system, they search for external excuses. The market becomes the problem, not their decisions. Overconfidence protects ego at the cost of growth. They begin to ignore feedback. When someone offers constructive criticism, it feels like an attack. When experienced traders share cautionary advice, it sounds outdated. The beginner starts underestimating those with more experience, assuming that modern tools or recent wins have given them an edge others lack. This is how development quietly freezes. Learning requires humility. Growth requires acknowledging limitations. Improvement demands the uncomfortable. admission that there is still much to understand. Overconfidence rejects all three. It builds a mental wall that blocks new insight. The trader becomes selectively blind. They only see information that confirms their beliefs. They dismiss alternative perspectives. They double down on ideas that once worked, even when conditions have changed. But markets are dynamic. They evolve. Conditions shift from trending to ranging, from high volatility to compression. Strategies that perform well in one environment may struggle in another. Without continuous learning and adaptation, performance inevitably declines. When a losing streak eventually arrives, and it always does, the overconfident beginner is unprepared both emotionally and technically. Losses feel shocking. They are no longer viewed as statistical inevitabilities, but as personal betrayals. The trader who believed they had mastered the market now faces outcomes that contradict that belief. The emotional impact is intense because it collides with identity. Confidence collapses. The same person who increased position sizes and dismissed caution now hesitates to execute even valid setups. Fear replaces ego. Doubt replaces certainty. Where there was once boldness, there is now anxiety. Ironically, the trader who felt unstoppable weeks ago now feels incapable. This emotional swing is exhausting. It drains mental energy. It erodes clarity. It creates inconsistency. One day, the trader is aggressive, trying to win everything back. The next day, they are paralyzed, afraid to take even small risks. Performance becomes unstable because the mindset is unstable. But the market did not suddenly become harder. The trader simply stopped evolving. Overconfidence is dangerous because it freezes development at the exact moment. Growth should accelerate. Early success should inspire deeper study, more refinement, and greater discipline. Instead, it convinces beginners they have already arrived when they have barely begun. In trading, stagnation equals regression. If a trader is not improving, they are effectively falling behind. Markets are competitive environments filled with participants constantly analyzing, refining, and adapting. A static approach in a dynamic environment cannot survive long term. Strategies require refinement. Risk management requires constant evaluation. Discipline requires maintenance. Emotional control requires awareness. None of these elements remain strong without deliberate effort. A closed mind cannot adapt. When new information appears, it is rejected. When performance declines, the response is denial rather than adjustment. The trader clings to outdated assumptions because letting them go would mean admitting they were wrong, and inability to adapt leads to elimination, not necessarily overnight. Sometimes it happens slowly, through gradual drawdowns, increasing frustration and shrinking confidence. Other times it happens quickly, through one aggressive attempt to recover. Losses with oversized positions. Either way, the root cause is the same. Overconfidence convinces a trader that learning is optional, that reflection is unnecessary, that growth can pause, but trading punishes complacency. The moment a trader believes they have nothing left to learn is the moment they become most vulnerable, because the market rewards those who stay curious, flexible, and humble. An open mind evolves. A closed mind eventually breaks. The cure for overconfidence is not fear, it is humility. Humility does not mean shrinking yourself or hesitating on every setup. It means respecting uncertainty. No matter how much you study or how many winning trades you string together, the market can still surprise you. Professional traders are not fearless. They are respectful. They respect risk. They respect probability. They respect the possibility of being wrong. That respect shapes their behavior. It keeps position sizes controlled, even after a big win. It keeps stop losses intact, even when they feel certain. It keeps learning continuous, because markets evolve and conditions change. Humility is what prevents a good week from turning into a blown account. The most dangerous trader is not the beginner who knows they are inexperienced. That trader is cautious. They ask questions and review mistakes. The most dangerous trader is the one who believes they have mastered something complex too quickly. A few wins convince them they have figured it out. They increase lot sizes. They stop journaling. They ignore rules they once followed carefully. That is when risk quietly compounds. True confidence grows slowly. It is built on data, repetition, and controlled risk. It comes from executing a process hundreds of times, not from getting lucky 5 times in a row. Overconfidence is loud and impulsive. True confidence is quiet and disciplined. Overconfidence wants validation. True confidence focuses on execution. It manages risk and thinks long-term. Traders who become consistent learn to separate ego from execution. They understand trading is not about proving intelligence or being right. It is about managing uncertainty with discipline. It is about probabilities, not predictions. The market does not reward pride. It rewards process. You can be brilliant and still lose money if you ignore risk. You can be average and build steady returns if you respect structure. The real edge is discipline. If you are a beginner, remember this. Wins do not make you skilled. Losses do not make you incapable. Only disciplined consistency builds longevity. A winning streak can inflate your ego. A losing streak can shake your confidence. Neither defines you. What defines you is how consistently you follow your plan. In trading, survival comes before success. If you cannot survive drawdowns, you will never experience growth. Humility protects your capital, your mindset, and your future opportunities. Every trade is just one of many. No single setup is worth abandoning your rules. Think long-term. Think in probabilities. The market will always be there tomorrow. The question is, will your account be? Choose humility over ego. Choose discipline over impulse. Choose process over pride. If this resonates with you, review your last trades honestly. Make sure you respected your risk rules. Tighten what needs tightening. Stay committed to the process. And stay in the game long enough to let consistency work in your favor.